I used to believe you needed a massive fortune sitting in your brokerage account before you could even think about living off your investments. You know the number everyone talks about, $1 million, sometimes two. And honestly, every time I heard that, I'd feel a bit discouraged. It made financial freedom sound like a club for people who started earlier, earned more, or just got lucky. A few years ago, during the summer, I was lying on the couch with my laptop open, the fan humming in the background, trying to figure out how long it would take to reach that $1 million mark. The numbers didn't lie. At the pace I was going, it would take decades, and that's if everything went perfectly. No surprises, no setbacks, just years of flawless execution. That's when I stopped and asked myself a different question, not, how do I get to $1 million? But what if the million was never the right measure to begin with? Because here's what nobody talks about. That number, the one that gets repeated constantly, it's based on a strategy that forces people to sell their assets just to live. That's not freedom, that's liquidation. And I realized I didn't want to spend my life building something just to tear it down piece by piece. This isn't about some magical shortcut or get-rich-quick scheme stuff. This is about understanding what actually needs to happen for investments to start covering expenses. Not in theory, in reality. And when I finally figured it out, the starting point was lower than what I'd spent on my last vacation. So let me walk you through what I learned. How I built a dividend-paying portfolio with Fidelity index funds. Not just to grow, but to pay. To sustain my current income and to create a system where I wouldn't have to sell anything to live. I'll share the mistakes I made early on, the exact funds I ended up choosing, and by the end, I'll show the actual amount that's needed to generate serious annual income. Plus how I'd cut a decade off the timeline with a slightly more aggressive approach. Quick disclaimer, I'm not a financial advisor. The information in this video is for educational purposes only. Always do your own research or speak with a licensed financial professional before making any investment decisions. Let's dive in. Here's why I chose Fidelity index funds over everything else. When I first started thinking seriously about building wealth, my mind immediately went to all the exciting stuff. Real estate, individual stocks, and digital currency. Those were the things everyone seemed to be talking about. Each had its own success story attached. I had a friend who bought a rental property and bragged about collecting rent checks every month. A coworker who got in early on a tech stock that later skyrocketed. And a cousin who wouldn't stop talking about how digital currency changed his life. And sure, I could see how those things could work. But I also saw something else. Risk, stress, and a lot of time. Real estate sounded great on paper, until I actually looked into what it involved. The down payment alone was huge. Then came the stories, tenants who didn't pay, midnight calls about leaking roofs, broken appliances, and maintenance headaches that never seemed to end. One friend who owned a rental told me he spent more time managing his property than he did at his actual job. Sure, he could hire a property manager, but that would eat so much into his profits that the whole idea started looking pretty average. And even then, it wasn't passive income. It was a business, one that demanded constant attention. Stock picking felt exciting at first. I spent weeks researching companies, reading earnings reports, watching prices tick up and down, until one of my picks got crushed by a surprise announcement. I watched months of gains evaporate overnight. And I realized something. I was spending hours every week just trying to stay informed, and even then, I was competing against experts with better information and faster systems. It felt like playing a high-stakes game I was never equipped for. For digital currency? Yeah, I gave it a shot. At first it was exciting. I watched my investment double. But then, after 6 months, it dropped by more than half. It felt like a roller coaster without a safety bar. One post online could send prices soaring or crashing in minutes. That's when I realized this wasn't steady investing. It felt more like chasing luck in a digital world. That's when I started looking seriously at index funds. They were simple. I could buy one fund. That fund owned hundreds of companies. If one company collapsed, it barely moved the needle. The fund kept going. I didn't need to watch the news every day. No earnings reports to stress over. No tenants. No midnight emergencies. It was one of the few strategies where I could actually build wealth while I slept. Not because it was magic, but because it was designed to remove the chaos. It wouldn't make me rich overnight. I wouldn't have some dramatic story to tell at dinner parties. But over time, it worked. Reliably and predictably. When most people start learning about dividend investing, the first instinct is to look for the highest number. A fund paying 7% sounds better than one paying 2%, right? If the goal is income, doesn't it make sense to grab the highest yield possible? On the surface, yes, but that logic is a trap. Here's the reality. High yields often come with high risk. When a fund or company is paying an unusually large dividend, it's usually because the market doesn't trust it. Maybe the underlying companies aren't growing, maybe the share price is falling, maybe the payout isn't sustainable. Whatever the reason, that big number is often a warning sign dressed up as a gift. I almost built my entire portfolio around that logic. I had a spreadsheet full of high-yield funds. The projected income looked incredible on paper. I was patting myself on the back for finding what I thought was the ultimate goal. Then I started digging deeper, and I noticed something. A lot of these high-yield funds had share prices that were falling or flat. The companies behind them weren't growing. Some had actually cut their dividends in the past. I was looking at yields that were high because the market didn't trust them. That big number wasn't a gift. It was a warning sign. Instead of chasing yield, my focus shifts to total return. That's three things working together. Dividend growth, and share price appreciation. It's not just about what the portfolio pays today. It's about how much that payment grows over time and how much the entire portfolio is worth down the road. Let's put it in perspective. A fund with a modest yield that grows its dividend at 15% a year will outperform a high-yield fund that stays flat. Why? Because compounding takes over. Those reinvested dividends buy more shares. Those shares pay more dividends. The cycle accelerates. After 10 years, the difference isn't small. It's massive. That's the engine. Not the highest yield, not the flashiest return. But the combination of steady payments, consistent growth, and rising value. That's what builds income that scales, income that lasts. But for this strategy to work, the funds have to be chosen carefully. Here's how to pick the right index funds. Picking the right index funds wasn't something I wanted to do based on gut feelings or whatever was trending. I needed a framework, a set of principles that would filter out the noise and focus on what actually drove results. There are 3 performance principles that guide this strategy. First, reliable dividend yield. The fund needs to pay something. Not a token amount that barely buys French fries, and not some unsustainable number that lacks backing. It needs to be steady, consistent, paid out regularly. This is the foundation, the starting income, the money that flows just from holding the investment. Second, strong dividend growth. This is where I saw most people missing the real opportunity. The best funds weren't just paying dividends, they were increasing them year after year. When I found funds with strong dividend growth, I realized they had a compounding effect on income. If a fund grew its dividend at 15% annually, those payments would double roughly every 5 years. That meant the income I'd receive in 10 years would be dramatically higher than what I started with, even if I never added another dollar. Third, share price appreciation. This wasn't just about income flow. I needed my portfolio to grow in value too. That growth would protect my purchasing power, build wealth, increase my total returns. Even if I never sold a share, that appreciation mattered. It was the difference between a portfolio that paid well and a portfolio that paid well and got stronger every year. And I added one more layer. Diversification. I wanted funds that covered different parts of the market. Mid-cap stocks, large-cap stability, international exposure, real estate investment trusts, small-cap growth potential. This would spread my risk, capture growth from multiple angles, make sure that no single sector or trend could derail everything I was building. At that point, I kept asking myself, why not just throw everything into the S&P 500? Isn't that what everyone recommends? Here's why I choose not to go all in with a lump sum. The S&P 500 is everywhere. It's the default recommendation, and I get why. It's simple. Diversified across 500 of the biggest companies in the US. Historically solid returns. For building long-term wealth, it's a great option. But when I ran the numbers for living off dividends, meaning consistent spendable income without selling shares, the S&P 500 didn't work. Here's what I found. The S&P 500 is built for growth, not income. Most of its returns come from rising share prices, not from dividends. The dividend yield on a typical S&P 500 fund is around 1 to 1.5%. The dividend growth is modest. The appreciation is strong, but that doesn't help when someone needs cash flow. I did the math on what I'd need. If I wanted to generate meaningful annual income from an S&P 500 portfolio, I'd need millions invested. Even if I stretched the timeline over decades, the required starting capital was intimidating. And if I wanted to actually spend that income, I'd have to sell shares. That wasn't sustainable, it wasn't predictable, and it defeated the entire purpose of building a dividend engine. When I compared that to a portfolio specifically designed for income, one with higher starting yields, stronger dividend growth, and balanced appreciation, the difference was stark. That kind of portfolio required significantly less capital to hit the same income goals. And the income kept growing without ever touching the principal. If you're already invested in the S&P 500, that's totally fine. I'm not saying you should switch. This isn't financial advice. I'm just sharing my own opinion and my personal finance journey. After months of research, I decided to build my portfolio around 3 Fidelity index funds. Each one had a purpose. Together, they form a system designed to reward me today, grow tomorrow, and compound quietly in the background. The first fund I picked was Fidelity Small Cap Growth Index Fund, FECGX. This one became my growth accelerator. It focuses on small companies with big potential, those early-stage innovators that might be tomorrow's giants. The dividend yield is modest, but the growth is where it shines. Over time, these companies tend to grow earnings fast, and that momentum compounds beautifully if you stay patient. The second fund is the Fidelity Total Market Index Fund, FSKAX. This became the backbone of my portfolio. It gives me exposure to the entire US stock market, large caps, mid caps, small caps, everything. The dividend yield is steady, the growth rate is strong, and it captures the overall power of the US economy without me needing to guess which sector will win next. It's my set it and let it run fund. The third fund is the Fidelity Small Cap Value Index Fund, FISVX. This one balances everything out. It focuses on undervalued smaller companies, those that might not look exciting now but have solid fundamentals and room to rebound. It adds income stability and a contrarian edge that helps smooth out the volatility from my growth picks. When I put these 3 together, something clicked. My portfolio started to feel like a real system. Growth where I wanted it, income where I needed it, and balance to keep me grounded. The overall yield is modest enough for me, and dividend growth has been impressive, and the long-term performance looks like something I can actually sleep well owning. Here's what happens when you start small. When I first started investing a few years ago, I remember feeling like I was already behind. Everyone around me seemed to be doing more, earning more, saving more, investing more. I didn't have much, but I decided to start anyway. Not with a high pay job or inheritance, just what I could set aside consistently. People told me it wouldn't make a difference, that it was too little to matter. But I wasn't trying to get rich overnight. I just wanted to see what would happen if I stayed consistent and let compounding do its thing. The first couple of years were slow. Progress felt invisible. But I kept going. Over time, something started to change. The dividends that once looked tiny began to grow. Reinvested shares started earning their own dividends. And without realizing it, the portfolio began to build its own momentum. A few more years in, the results became impossible to ignore. The growth wasn't coming from my new contributions anymore. It was coming from what the portfolio had built on its own. Compounding had taken over. That's when I understood something most people miss. You don't need to start big, you just need to start. Because consistency turns small beginnings into something powerful. That's how you build an income engine that works quietly in the background. Here's the real truth nobody talks about. The lowest amount needed to live off Fidelity index funds isn't millions. It's not even hundreds of thousands to start. It's whatever someone can invest today, combined with the discipline to keep going. That's the real answer. Not what most people think, but what actually works. And it's what changed everything for me. This isn't financial advice, and I'm not suggesting you invest here. I just want to share my experience and maybe motivate someone. If you found this helpful, hit like and subscribe and check out the video above. It's full of tips and strategies you won't want to miss. See you there.